Bitcoin platform River just put out a great report showing how large a percentage of Bitcoin purchases are now coming from companies rather than from individuals. Sam Baker and Vincent Lee write that businesses have emerged as the primary force behind Bitcoin's ongoing bull market. The report says that these treasury companies account for 76% of all Bitcoin purchases since January 2024 and 60% of publicly reported business holdings. Now, ever since MicroStrategy became the first public company to hold Bitcoin on its balance sheet, we have seen an explosion of other companies follow. So it's obvious these treasury companies are a big reason for the continued Bitcoin bull market. But it's important to remember that although these companies are buying a lot of Bitcoin, they are still slightly behind funds and ETFs, which are the largest category buyer of Bitcoin so far this year.
For most technologies, the adoption curve starts with governments, trickles down through corporations, and only then reaches the public. Bitcoin tore up that playbook. It began as a grassroots movement, ignored by companies and resisted by governments. The earliest adopters weren't institutions but regular people who believed in a different kind of money, and they've been rewarded for it. Now the tide has turned. Anthony Pompliano points out that corporations are leading the next wave of Bitcoin demand. In just the first 8 months of 2025, businesses poured $12.5 billion into Bitcoin, already outpacing all of 2024. Treasury-focused firms account for most of this activity, making up 76% of purchases and holding 60% of company-owned Bitcoin. MicroStrategy set the precedent years ago, and today more than 50 public companies worldwide each hold at least 10 Bitcoin. This isn't confined to the US anymore. It's a global trend. Public companies, funds, ETFs, and private businesses are stacking alongside retail investors, creating a strong foundation for the ongoing bull market. What's striking is the scale of commitment. River's data shows that companies using its services allocate, on average, 22% of net income to Bitcoin, with a median of 10%. That's far beyond the often cited 1% safe allocation example. And the momentum is clear: allocations are rising, not shrinking. What this really signals is a structural shift. Bitcoin is no longer just an outsider's bet. It's becoming a strategic asset on balance sheets worldwide, and corporate adoption may be the fuel that drives the next leg higher. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
One of the interesting things is that Bitcoin adoption happened in a very, very special way. Most technology is first used by militaries and nation states, then the corporations adopt it, and finally the average person is given access to the technology. This has happened with the internet, with phones, computers, and many other innovations over the last century. But Bitcoin's been different. The people adopted Bitcoin first. Nation states, they thought about banning it. They fought it. Corporations, they thought it was too risky. They avoided it. It was the average person who did the work to understand the asset. They realized the market opportunity, and they took the leap of faith to buy and hold the world's first decentralized digital currency. And those people, they've been rewarded well for taking that risk. But now corporations are working hard to catch up. Bitcoin platform River just put out a great report showing how large a percentage of Bitcoin purchases are now coming from companies rather than from individuals. Sam Baker and Vincent Lee write that businesses have emerged as the primary force behind Bitcoin's ongoing bull market. In the first 8 months of 2025, Bitcoin inflows onto business balance sheets have already exceeded the total for all of 2024 by $12.5 billion. Now, a big reason for this significant increase in accumulation from businesses has been the recent rise of publicly traded Bitcoin treasury companies. Everyone's talking about them. The report says that these treasury companies account for 76% of all Bitcoin purchases since January 2024 and 60% of publicly reported business holdings. Now, ever since MicroStrategy became the first public company to hold Bitcoin on its balance sheet, we have seen an explosion of other companies follow. It's estimated that there are now more than 50 other public companies who hold at least 10 Bitcoin each. And these companies are not just in the United States. In fact, the Bitcoin treasury phenomenon has become a global game almost overnight. There are public companies in nearly every market who continue to convert their local currency into digital sound money. And I don't think that's going to stop anytime soon. So it's obvious these treasury companies are a big reason for the continued Bitcoin bull market. But it's important to remember that although these companies are buying a lot of Bitcoin, they are still slightly behind funds and ETFs, which are the largest category buyer of Bitcoin so far this year. Now, it's healthy to have various types of buyers in a bull market. So it's good to see the demand coming from funds, ETFs, treasury companies, private businesses, and individuals alike. But let's go back to the idea for a second of companies holding Bitcoin. Most companies are never, ever, ever going to put majority of their balance sheet into Bitcoin. They just think it's too risky or it's too new for them. At least they're not going to do it in the short term. So a much more realistic scenario is for companies to put 1% of their balance sheet into the digital asset. 1% may not sound like a lot, but look at the difference a 1% allocation would have made for Microsoft, Google, and Apple since 2020. Each of these companies has seen their balance sheet's purchasing power erode from $14 billion to $21 billion since 2020. Just think how crazy that is for a second. The silent tax of inflation has stolen $14 billion of shareholder value in half a decade. It's crazy. It's insane. If these same companies had allocated only 1% of their treasury to Bitcoin in 2020, they each would have seen a treasury gain of $14 billion to $29 billion in that same half decade. We're talking about a $25 billion swing or more in each one of these companies. And the risk that they would have had to take was only a 1% allocation. It seems like such a no-brainer in hindsight. So this brings me to my last point, which is what companies are actually doing in terms of their allocation percentage. River's data shows that many businesses are actually allocating far more than the hypothetical 1% to Bitcoin. Businesses using River allocate an average of 22% of their net income, according to a July 2025 survey. The median allocation is 10%. So there you have it. An allocation as little as 1% would have had a profound impact on most companies' balance sheets since 2020. But the average allocation has been 22% of net income, and the median allocation has been 10%. Something tells me that those percentages, they're only going to increase over time.
Anthony Pompliano doesn't mince words. If you're sitting on cash, you're falling behind. The dollar is losing value faster than most people realize, and in this system, savers are punished while asset holders get ahead. Over the past 30 years, $1 has lost half its buying power. Since 2020, purchasing power has dropped another 30%. That erosion isn't abstract. It shows up in higher rents, pricier groceries, and the widening wealth gap that makes people feel trapped. Pompliano argues the real divide today isn't between rich and poor, but between those who own assets and those who don't. Stocks, real estate, gold, Bitcoin, these are the lifeboats when the dollar sinks. Cash, on the other hand, is like an ice cube in the sun. It only melts. The deeper issue, he says, is financial literacy. Too few people understand how money works, how inflation compounds, or why relying on savings alone is a losing game. Schools don't teach it. Instead, generations grow up believing holding cash is safe, when in reality it guarantees loss. Pompliano points to Darius Dale's observation. The Fed may claim to target 2% inflation, but lived reality is closer to 3%. That's the real speed at which purchasing power disappears. For individuals, the lesson is clear. Owning productive assets isn't optional anymore. It's the only way to stand still, let alone move forward. In this system, wealth is about what you own, not what you save. Let's get back to the interview.
Anybody who is holding dollars, just simply saving in cash, they're going to be losers in this economy, because the dollar is going to be debased. But the people who are holding assets, whether it's stocks, gold, Bitcoin, real estate, or anything else, they're going to be winners, because as that dollar is debased, those asset prices are going to go up. And that is ultimately the intelligence test of our generation. Are you holding cash or are you an investor? Winners and losers. That's the bifurcation. And so if you understand this, then the thing you need to do is spread the word. Over the last 30 years, $1 of purchasing power became 50 cents. Just since 2020, we have seen the dollar lose 30% of its purchasing power. That is why we have wealth inequality in this country. And ultimately, that is why such a large percentage of people feel like they continue to fall behind. They're holding cash. That cash is melting away like an ice cube. And they need to learn to convert it into assets, because asset owners are winners. And so ultimately, the wealth inequality gap in our country is really driven by a financial literacy problem. It's a national emergency in our schools. We should spend an enormous amount of resources helping people better understand financial literacy, understand how to invest, and learn that saving is a losing strategy when they're debasing the dollar at an accelerated rate. I sat down with my friend Darius Dale yesterday, and he explained to me why he thinks that the Federal Reserve is wrong. He says that their inflation target at 2% should actually be 3%. And regardless of that target, actually 3% inflation is really what's going on in the economy.
You've got some data here that shows that actually, regardless of what the Fed's target is, 3% may be closer to reality. Consumer finances says 3% is the new 2% too?
Yeah, so the Fed does this monthly survey of consumer finances, a lot of good data in there. Some of it very accurate, some of it not so much. But one of the things that has been pretty accurate is their inflation expectations. And if you look at the Fed's 3-year, the Fed's 1 year, so the respondents in the most recent survey of consumer finances said on a 1-year basis, inflation is likely to be 3.1%. On a 3-year basis, inflation is likely to be 3%. And on a 5-year forward basis, inflation is likely to be 2.9%. So essentially, the Fed's own survey of consumer finance from consumers are telling the Fed, we think inflation is 3%. Our model saying inflation is 3%. The Fed's own survey is saying inflation is 3%, yet the Fed wants 2% inflation. And in our opinion, that's creating a lot of K-shaped outcomes in the economy. And so it's our belief, going back to where we started this conversation, that, hey, the administration is going to continue to pull the levers that they can pull in the context of what their authorities are. And obviously, this is an administration that has no problem, extending the boundaries of those authorities in certain respects. And you can argue it or not argue it. But the reality is they're going to continue to do it, in our opinion, because ultimately, I think they understand everything that you and I have been talking about for years, which is, hey, this is not an economy that needs an arbitrary 2% inflation target. This is an economy that needs a lot more real economic. And ultimately, the Fed acknowledging that 3% inflation should be the new bogey and running monetary policy credibly from there, in our opinion, would create better economic outcomes. That's just a hunch.
Now, I think most people know I'm not really the biggest fan of the Federal Reserve and how they've been operating. They're constantly behind the curve. But hearing Darius explain this, using their own data to explain that inflation target of 3% seems to make a lot of sense to me. I don't think that they're going to actually end up changing this thing. If anything, they'll just remove the inflation target. But that argument from Darius Dale is pretty compelling. And I think that the Fed's behind the curve. It'll continue to be behind the curve because they keep using bad data to make decisions. And until they fix that problem, you just can't get ahead.
Public companies have now crossed a major milestone. They collectively hold more than 1 million Bitcoin, worth around $110 billion. What was once considered a fringe asset is now sitting on corporate balance sheets across the globe, and that shift speaks volumes about how far Bitcoin has come. This isn't just about price action. Hitting the 1 million BTC mark signals that Bitcoin is no longer confined to retail investors or niche funds. It has moved firmly into the mainstream of corporate finance. For companies, the decision to hold Bitcoin isn't only about potential gains, it's also about hedging against inflation, diversifying away from fiat risk, and staking a claim in what many see as the future of money. The sheer scale of these holdings means corporations aren't just passive participants. By committing this much capital, they're actively shaping the market's trajectory. The message is clear: Bitcoin is being taken seriously as a long-term reserve asset, not just a speculative trade. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.